So this is actually very exciting. It's something that has never happened before in the history of the tax code, or at least the tax code that I know of, and it is the ability to write off interest on an auto loan, on a car loan, especially one that you own personally. You've always been able to write this off as a business. If you own the vehicle as a business asset, interest was deductible as a business expense, but never could you go and buy a car as an individual and write off the loan interest. That is now available, but like everything in the tax law, there are certain limits and certain kind of gotchas that are in there. So we'll go through those things and hit on those today. Now, my name is Merrill Taylor. I'm a CPA. We help high earners and business owners cut taxes proactively. This video is educational. It's not individualized advice, so make sure you talk to your CPA before taking any action. Now, the One Big Beautiful Bill created a temporary deduction. This wasn't a permanent one, just a temporary, for auto loan interest, and it's available for tax years 2025 through 2028. Now, if you qualify, you can deduct interest that you pay each year up to $10,000 annually, and this deduction is available even if you don't itemize. So a lot of people don't itemize their deductions, so even if you don't itemize, you can still take this deduction. Now, to claim it, you need to pass all of these tests. There's several tests here. Number one, it needs to be a new loan on a new vehicle. The loan must originate after December 31st, 2024, and the car's original use must start with you, so used cars do not qualify. So you got to buy a new car, and that new car had to be purchased starting January 1, 2025 or later. Now, the vehicle must be personal use only. This is not for business or commercial use vehicles. Business use stays under the usual mileage or actual expense rules. There's no double dipping. You can't take, like, buy a vehicle for business, take the mileage, and then deduct interest on top of that. You have to kind of follow the rules as they work. And a lot of times mileage and loan interest actually are allowed to take as a business expense, but again, you wouldn't take the interest expense as a personal deduction. That would have to be business. So anyway, just no mixing between the business and the personal rules there. The other rule that we run into is that the final assembly of that vehicle must be done in the U.S., in the United States. The vehicle must have final assembly in the United States. You can verify on the window sticker or by checking the VIN with the NHTSA VIN decoder. There'll probably be a directory you can look up that says what vehicles qualify, and there'll be some lists that pop up and show which vehicles qualify. So look up your vehicle, make sure it qualifies before you purchase it or before you try to deduct the interest on it. It must be a secured auto loan, which means the interest must be on a loan that's secured by the vehicle, and leases don't qualify. So if you lease a vehicle and have an interest component, you can't write off any part of that lease expense. It must be a vehicle that's purchased. Then there are income limits that set in as well. So to get the full benefit, your income needs to be $100,000 or less if you're single, or $200,000 or less if you file a joint return. And then the deduction phases out when your income goes above those income levels. And then on the tax return, you'll need to enter the VIN, the vehicle identification number, for any year you claimed the deduction. And lenders will have a 1098 style reporting starting with 2025 on these loans. So you'll actually, like, when you pay mortgage interest, you get a 1098 from the mortgage company showing you how much interest you paid and how much interest you can deduct. They also send that 1098 to the IRS, so the IRS can verify and double check that on your return. There's going to be a 1098 style reporting requirement as well that you'll get from your auto loan lender that will show you what is deductible in there as well. Now, this is a deduction and not a credit, so it reduces your taxable income. Then your tax falls by your marginal tax rate times the deductible interest. So as an example, if you pay $2,400 of interest and are in the 24% tax bracket, then that will save you $576 in tax. So it's not like if you pay $2,400 in tax, or $2,400 in interest, you save $2,400 in tax. Instead, it's a deduction that would actually, in this example, save you more like $576 in tax. As another example, if you pay $1,200 in interest and you happen to be in the 32% bracket, then that saves you $384 in interest. And most buyers won't come close to the $10,000 annual interest cap. Typical savings are a few $100s a year depending on loan size, rate, and bracket. And then again, that phase out note, if you're above 100,000 or 200,000 of income, the deduction shrinks and can phase out completely at higher incomes. And so you'll want to check with your CPA if you're near that line. Now, here are the biggest kind of gotchas, the biggest kind of things to look out for. There are dealer hype versus the interest rate. Don't accept a worst interest rate just to chase this deduction. A 0.5 to 1% point higher rate can wipe out the tax benefit. So you're going to want to run the math. If the dealer's sitting there saying, try to tell you that the tax savings will be so great, and then they try to up the interest rate on you, then that could end up just washing. And then who gets the benefit? The dealer or whoever makes the loan. It's basically just trying to take that benefit away from you. So be aware of that. Make sure that your interest rate is a market interest rate and not inflated for that. Now, business owners, this break is for personal vehicles only. If you're taking mileage or actuals on a business vehicle, then you can't also claim this as a personal deduction. Used cars and leases, neither qualifies under the statute. And then documentation. Make sure you document all of this. Expect a lender statement and keep your VIN and interest totals handy at tax time. Now, if you're eyeing an EV, an electric vehicle in 2025, you should know this. The federal EV credits end for vehicles acquired after September 30th, 2025 under the One Big Beautiful Bill. There's a short window when qualifying U.S. assembled EV could potentially get the expiring EV credit and still meet the auto interest deduction rules going forward if all the boxes are checked, if you meet all the requirements. So there could be a possibility of combining an EV credit with an interest deduction and get both of those, which would be a great benefit. Timing and sourcing matter, so you're going to want to run by that CPA and do a lot of kind of research just to make sure everything qualifies. So here's how you can verify your car qualifies. Number one, check the window sticker for final assembly in the United States. If you're unsure, then run the VIN number into the NHTSA's VIN decoder to see if the plant of manufacture. Confirm your loan is secured by the vehicle and originated January 1st, 2025 or later. Also make sure that you're buying a new vehicle, not a used vehicle, and then keep the VIN for your return and watch for your lender statement to come. If they come like normal, then they'll probably come in January of next year. Now, should you buy just for the deduction? Generally not, because you want to buy because the total cost of ownership makes sense. You're going to buy a vehicle anyway. The purchase price and interest rate and insurance, depreciation, you want to look at all those sort of things. Treat the deduction as a sweetener, just kind of like an added benefit. It's kind of like, when you call and subscribe to, back in the days, you'd call and subscribe to a magazine and you get some kind of a prize or a benefit, or, when you sign up for something, sometimes they send you a benefit. Like, I know banks, when you go into the bank and you sign up for a loan or a new account, sometimes they give you some kind of a small gift. Right? You don't really go into the bank and sign up for an account just to get the gift. The gift is usually pretty small and meaningless. That's kind of how this deduction is. It's just like an extra added bonus on there. If you're going to buy a car anyway, then you just get this extra deduction, but it's not something that you necessarily go and buy a car just to get the deduction for. That doesn't really make any sense. Because like we said, for some it's just a few $100 a year, and you've got to be watching out for the dealer or the loan person that they're not like basically taking that benefit away by upping that interest rate on you. All right, now some quick rapid fire frequently asked questions on this. We've covered some of these, but we'll just cover them real quick again. So number one, do you have to itemize? No, you do not. It's available whether or not you itemize. Does financing kill the eligibility? Refinancing kill the eligibility. So yeah, generally an interest rate on a later refi of a qualifying loan remains eligible for the refinanced amount. So yes, you can refi if, say, loans were to change or something, loan rates were to change. Now, what about motorcycles and trucks? Yes, they qualify as long as the GVWR, the gross vehicle weight, is under 14,000 pounds and the final assembly is in the United States. Company car or Schedule C vehicle, do those qualify? The answer is no. The vehicle must be personal use only, not business use. Cars that are bought for business use have their own ways of deducting interest and other things for business use. All right, so here's what to do next. Verify the U.S. assembly before you sign. model the real tax savings versus the interest rate that you're offered. Decide based on the total cost, not just the deduction. And if this was helpful, then make sure that you tap the like and subscribe buttons and share it with someone that's shopping for a car, and we'll make sure to keep you posted on any developments.